Welcome back. I am Charles Musgrove, your host of Answers That Count, and welcome back. Happy New Year to 2021. We have the year 2020 in the rearview mirror, so we're looking forward to a new year, and we're in January right now, and we're talking to Rick Kahler today, and Rick is from Rapid City, South Dakota. Welcome to the show, Rick.
Thank you, Charles. It's good to be with you.
It's great for you to join us today, and we are Rick. Just so you know, we have the opportunity for everybody to please subscribe to the channel. You can hit that subscribe button, hit the notification bell, and whether you're watching on YouTube or whether you're watching on Roku TV or Amazon Fire, make sure to subscribe and get the notification bell. And we're on all your favorite podcast channels as well. So whatever your favorite platform is, we're out there. Just check us out and listen to it. And we've got today, we try to ask the questions so that we can get the answers for the business owner they can help them run their business better. Just so they're better educated, they're better informed, and they make better decisions about how to operate their business, decisions to make in the future. And there's probably no better decision that the business owner needs to go through is to understand how to maximize the valuation of their business, because their business is probably one of the highest valued asset that they have, whether they know it or not. They need to take the steps early to maximize that valuation. And Rick is an expert in that area. He has done valuations in the past. He helps people with financial planning. So this is a big part of what Rick does and how he advises his clients. So Rick, thank you for joining us today. I think you're going to bring some great knowledge and expertise to the show, and we're just going to try to make sure we get those questions out there so you can give us the answers that we need to hear today. So thank you, Rick. Oh, how cold is it out there at South Dakota today?
Right at the moment, it's 43 degrees. A couple weeks ago, we had a week of 60-degree weather, and but it gets cold here at some point in time. We have winter for 30 days. We just never know which 30-day period.
Only 30 days now, but your definition of winter is probably different than what ours is here in Florida.
Our our climate is very similar to Boulder, Colorado, which is 400 miles south of us, but we're on the east side of the Black Hills, so we get a lot of Chinook winds. It's actually This climate is called the banana belt. Now, I've never seen a banana tree
A
growing.
banana belt. How did they get that name?
I don't know, but we're actually we're a little 20-mile area of a kind of a dry arid uh, climate.
So it's cold and dry, so that makes it even colder, right?
No, cold and wet makes it cold,
Okay.
cold and humid.
So it
So
can drop really low and it will not feel as bad as it does here in Florida where we have some humidity.
no, when you guys get in the 40s, it's cold. It feels like 20
All
in
right.
Rapid City, South Dakota.
I'm glad you said that. That makes me feel better and not like a wimp of the cold temperature. So let's dive right in now. I want to throw this curveball out there to start with. So we have all of the rules and what we typically would do and how you would advise clients on the valuation of their business and what to look for in a sale or a ownership transition in the future. So now we have the curveball that happens, which is going to take place on January 20th. With if we get the full Democrat suite of the House, the Senate, and the White House, then we could really see some dramatic changes in the tax law that may affect what you would typically tell your clients. Is that right?
That's right. Yes.
Well, let's go through some of those. So kind of pick those off, and if you want to go back a step and maybe start with what the normal process is.
For valuing a business.
Valuing a business, because we're looking at that business as really a keystone element in a business owner's assets.
Yeah, absolutely. It's usually, like you said, the big asset. And it takes some paying attention to, especially when you want to monetize the business and you want to sell it and hopefully retire on the proceeds, or sell a portion of it and fund your retirement on some of the dividends. So the important thing to do, Charles, is to start getting ready for any transition years before the transition. Um,
So you
and
couldn't
one of
start.
the,
I wouldn't roll out of bed today and say I want to sell my business right now today. You would want to do that 5 to 10 years, probably at easily 5 to 10 years before the transition date.
yeah, and it may not have to be that far in advance. There's a couple things to look at. One is in the operation of the business, and the other one is in the book of the business. Maybe we should take a look at the books of the business first, which maybe if you started 2 or 3 years ahead of time, and you want your books to really be clean. You want to take out all of the legitimate business expenses that aren't necessary to the running of the business. So you may be running one, maybe you're writing a car off. Let's take my business of financial advising. Totally legitimate to put a car into the business and deduct a portion or maybe all of it, depending. But is it absolutely critical to the running of that business? Well, probably not so
Probably
much.
marginal on that.
So anything that's being run through the business, especially if there's personal stuff being run through the business that's not being tagged as such,
Right. So you
start
you
getting
may
that
have
out.
so your motivations really your incentives and your motivations change when you're running a business not thinking about selling it versus when you want to prep it to sell, because even though you may have a legitimate tax deduction that you run through the business, maybe that's not maximizing how the valuation is going to take place or be calculated to sell the business in the near future.
Absolutely. When I was appraising businesses, I would check for all of the potential personal expenses that were being run through. And if I was convinced that they were, I would do what's called stabilization of the cash flow, and I would take those out of the cash flow to look at what is the real profit here. But some of the problem that you have are, number one, some appraisers won't take those out. And number two, you have buyers that may not take those out, may not be convinced that they were really personal.
Right.
So you end up hurting your valuation by having those in there, even though it makes tax sense.
Right. So you probably want to any eliminate as many discussion points as possible. So if you can take those out, then you're not even having a conversation about it.
Exactly. And the less adjustments to stabilize income that you have, the easier it is, the more believable it is. And at the same token, Charles, I wouldn't stop taking legitimate deductions just to make the books look better, whether it's depreciation or things of that
Right.
type. I mean, buyers will be able to understand things like that. They
Absolutely.
took 100% depreciation on a piece of equipment,
Right.
and that's a real legitimate add-in. So don't be crazy about it, but start working to get the books really clean.
Absolutely. And it's probably, correct me if I'm wrong, but let's say that you are, maybe you take a trip that is marginal, whether it's a tax deduction or not. Instead of taking that, uh, expensing out that trip, maybe you have a higher compensation. Explaining a compensation to an owner is probably an easier discussion than trips or cars or other things that are included in the business cost that is shown on the income statement.
Yeah, that's true. And of course, the pushback on that could be, well, as compensation, depending on how much the compensation is, there may be the 15.3% FICA tax, which
Right.
you wouldn't have on a direct expense. Um, but and you hit another point, compensation.
Right.
You want to adjust your compensation to reflect fair market. And this is probably the one hardest thing for a lot of business owners to do.
Does that mean you're going to normally increase it or decrease it?
Yes. Um, It, in some cases, you're going to want to decrease your compensation because you're taking out way more than the value of services that you're providing to the corporation or the company. In other cases, you're going to want to increase it. And back in the days when we had a lot of C corps and we had the 15% bracket,
Yep.
uh, typically the compensation from the owner of a C corp was
Right.
overstated,
Right.
and the compensation from an S corp was typically understated because we're
Exactly.
trying to throw as much into FICA, non-FICA, right?
That's right. Do a distribution so they avoid the payroll tax.
Exactly. So it certainly needs to be addressed in your valuation. You know, a buyer might be able to understand that. Yeah, I get you were taking a $30,000 a year salary out of your S corp. You really should have been taking 100. I get it. And so the important thing to do, maybe you don't want to change how you're reporting your taxes, but you would, on your valuation, you would increase your wages by $60,000 or whatever, thus decreasing your profit.
Right.
Now, a buyer is going to get that. But it's really important that the value of the business is based on the true market value of definitely the owner's salary.
Right. Yeah, and that's obviously when you make that adjustment. If you're moving it all off of the balance sheet as a distribution and showing it as an expense, then you're ultimately reducing the valuation because you're showing less net income, less EBITDA that's calculated from the P&L.
Exactly. And it can be a hard emotional push when your salary is higher. For example, one thing I would always do as a business appraiser, I'd come in, I'd ask the owner one of the first questions, are you being paid fairly? Oh, no, no, not at all. Oh, what should you be paying? Twice of what I'm making. Okay, great. And when you did that adjustment, there's no profit,
Right, right.
right?
Yeah, I
And
see
it's
that
like,
too. It's like the owners, a lot of times they put extra work in for no compensation.
exactly. And so an owner is oftentimes used to talk about their profit. What'd you make last? Oh, my profit was X. And in profit, they're including compensation for their wages. In other words, especially if you're a Schedule C filer,
Right,
it's just falls down what my profit was. There is a difference between the fair market value of your wages and the profit. And it could be, and this is more the case than not with small business owners, there is no profit
right.
when you adjust for your wages. And I would ask them, if you can go to work for somebody else, what would you earn? Oh, great. I would earn so much more. Oh, great. Why aren't you?
Right. Yeah,
Well, I want to,
that's an uncomfortable conversation to have with people that hey, you could be making more money working for someone else than you do in the business. And that
yes,
I think you're also making the point that when you're involved in that buy sell situation, that you've got to get the expectation correct also from the seller standpoint, that he may think his business could sell for $10 million, but by the time you do those adjustments and show what it really is making, that maybe it's half that, or it's a different number, it's a lower number than what the expectation is.
absolutely. It's just crucial. And I remember there was one business owner I was working with, and I looked at the fair market value of what he was providing to the business, and it was quite frankly a minimum wage position.
Yeah.
And I reduced his income by 75%. Now that went to profit, but he was just kind of angry about
Right.
that I was personally insulting his abilities, but all he was doing was a minimum wage job.
Right.
But that did increase the profit.
Right. Absolutely. So um if we were, let's say that the business owner, they did this back a few years ago, and they're looking for a transaction date to happen in 2021. So if you're looking at 2021 transaction date versus 2020, then there potentially is going to be some different rules in play in 2021 that we haven't seen yet. So what do you expect the changes from a tax standpoint? If there's other changes, then bring those up as well. But at a minimum, we're looking at some potential tax changes in the tax code that most likely will take place or be effective 1/1/2021.
Yeah, the election really threw us a curve because we thought we would know on November 4th or 5th what the makeup of the Congress was going to be. And of course, we had the runoffs in Georgia that kind of put things on hold. And we were telling folks, well, if you're selling, close it in 2020 because we know what the law is now.
Right.
And of course, the odds were that the Senate would stay Republican, we'd have a split Congress, and probably the tax code wouldn't change. Well, that's not what happened. So what we know is we know that President-elect Biden has put out his tax policy, and part of that is at some level the elimination of capital gains. Now, will that happen? We don't know. As we were talking before we went on air, Joe Manchin from West Virginia is going to play a pretty big role in a lot of what happens. So I think if I'm looking at a sale, if I have even negotiated a sale and I have a closing, maybe even in February or March, I think I would be doing everything I could to move that sale up just as soon as possible. And I lived through the Tax Simplification Act of 1986, so I'm dating myself. And that's when I learned that titles to acts have no meaning to what it really does, because there was no simplification.
Right.
And
Exactly.
under that act, at that time, I was a commercial real estate broker, appraiser, and there were folks that had closed a lot of deals. For example, right now, if you've got a closing, let's just say in March, and legislation is introduced, let's say the first week of February to change the tax code. And that, for some reason, doesn't get passed until April or May. It's highly possible that all of the sales that happened between the date the legislation was introduced and the date it was passed or becomes effective as such will retroactively go back to the date it was introduced. And that's what happened in 1986. So a ton of folks that sold real estate and businesses and were counting on the capital gains, the law in effect at that time, just got nailed.
So you're saying that, let's say this legislation passes, that there's a high probability that 2021 we're going to have a split year, that the first part of the year we may get the old rates of the 20%, and after the legislation is signed, then it goes away, or whatever benefit of that capital gains rate goes away.
Absolutely. And you could be watching that legislation and talk of capital gains being included, elimination of elimination not included. And during this time you close, and then what comes out in the final bill is an elimination, and you could end up getting nailed.
Yeah.
So if you can close it before January 20th, that would be optimum. And absolutely try and close it before any legislation is introduced. That would be the safest thing to do, to fall under the current capital gains rate, because if they eliminate it and they're talking about moving the top tax bracket back to 39.6, I think it was 39.8, we could be seeing close to a 40% capital gains rate. And if you live in a state that's not Florida or not South Dakota and has personal income tax, you can be looking at 50-55% capital gains rate, say if you lived in California.
Wow. So what we're looking at there, really, if it's 20% now, you could have an additional tax of 25 to 30% if if legislation goes through to remove the capital gains rate.
Yeah, it could, on the federal level, it could almost double.
Yeah.
There may not be any change on the state level,
Right.
but it could be significant. And here's what I hope they don't do is eliminate the 1031 exchange.
Right.
And there's talk about that.
Yeah.
So we could be faced with a real mess here when it comes to taxation on the sale of a business.
Right. And the inheritance tax, they're talking about affecting that as well.
Yeah, we've been preparing for that. We helped a number of clients set up intentionally defective grantor trusts last year, back when it looked like the nominee was going to be Bernie Sanders, and he favored rolling it back from, say, it's around 12.5 right now, the exclusion, to 3 million.
Right.
Oh, wow.
That's big.
That can really impact you if you've got a 15, 20, $30 million estate. That's a big deal.
Right.
So there still would be a chance to do that planning. And that's something that folks should take a look at, especially if you have an estate, say over $10 million, you still could set up these types of trusts, and they are complicated. They have a lot of moving parts, but it's a way to use the difference between, say, if they roll it back to 3 million, your $3 million credit versus 12 million. So 8.5, $9.5 million that you could get out of your estate tax free.
Right. Yeah, that's a big deal. So, we kind of pivoted from positioning your company for a sale into the taxes, and those still relate. I mean, the capital gains affects that sales strategy. If you were looking at it when Trump went in back in 2016, if your window was within the next 5 to 8 years or 10 years, you would have tweaked your planning strategy based on how the administration looks, whether you're the Congress as well as the White House. So that could have been strategy that you took into account then, as well as what we're looking at now with the Democrats and the potential higher tax rate. So all of that comes into play in your planning for your transition. And it may not sound like a lot, but when you look at 20 to 30% additional tax, that's 20 to 30% haircut on your sale price is what you're looking at, which is dramatic.
Well, it is dramatic. I mean, if with those proceeds, arguably, you probably are going to put them in some type of diversified portfolio that may earn, let's just say 5% a year over the long term. Well, if an extra 20%, 25% is gone, that's a lot of potential earnings. I mean,
Yeah.
it's a big deal.
It is.
And it could be the difference between selling and not selling.
Right. Yeah, I think you're exactly right. It's not that I'm pitching your company or what you do personally, but I'm going to tell you that it makes sense to work with someone like you when you're doing these strategies, because maybe as silly as it sounds since we're talking about this, but maybe you don't take into account the federal income tax effect on the sale, and that would be a big mistake to do that, because that really can dramatically affect what you get in your lifestyle after retirement.
And it also brings up some other strategies. We talked about the 1031. So I'm working with a client who's looking at a sale. And instead of doing a sale outright to this company, if this comes down and we can't move it up, we may want to do a merger. We may want to do a 1031 exchange for shares in that company and bid our time
Right.
before we cash out.
Exactly right.
And so we'll get dividends on not only an extra, say 20 or 25%, we may be getting dividends now on 50% if I'm in a high tax state that could have gone elsewhere.
Right.
That's a big deal.
It is a big deal. So the bottom line is to make sure that when you're planning this, that you plan for it far enough in advance, and it also, if you plan for it far enough in advance, it gives you the opportunity to shift the final timing of that. A lot of times, if it's going to be in a high tax rate administration, or whether you can defer that till after they're out.
Absolutely. And Charles, I'll bring up one other thing I see with small businesses that have a lot of family.
Right.
This is when you might want to start 5 to 10 years ahead of time. Because I dealt with a client that had all the top jobs of the company were filled by family members. And that really needs to be addressed. Are those family members going to stay?
Right.
Are they not? How is a new buyer going to look at that? And you really hurt yourself if you're going to pull out key family members out of a sale. They really need to be replaced years before the
Right.
transition.
Exactly right. And maybe some of those family members are part of the thing that you have to clean up to make sure that the financials look the best as possible as well, because maybe the family members are in those positions because they are family members and they're not the best skilled person for that position.
Yeah, I had one client that paid all family members the same salary.
Wow. I guess that maybe that eliminated arguments or conflict within the family, but I doubt it. So, Rick, before we jump into another topic, we are not through with this. We've got a lot more to discuss. So, unless you're on the radio, everybody just hang on, and we're just going to take a quick pause. The radio audience will drop off. You've been listening to Charles Musgrove with Answers That Count. We've been talking with Rick Kahler from Boulder City, Rapid City, Iowa, or South Dakota. So just hold on, Rick. We're going to be right back. And audience, hang on. We're going to take just a 3 or 4 second break. Rick from Rapid City, South Dakota, 40-degree temperature out there. Let's continue that. So we've been talking about how to position the company both on the financial statements, as well as we're going to jump into some operations too. I know that we teased that earlier in the show, and how the tax laws that are in effect really have an impact on the timing of the sale and how to plan for that sale if you have to go through with the transition in a high tax year or high tax administration.
Right. All looking at all of that is so critical to get the company just as clean as you possibly can for a buyer, eliminating all the potential obstacles and making it easier for the buyer to see the value, and maybe making it easier for the appraiser to see the value.
Yeah,
and then addressing the tax issues.
Yeah, the taxes are a big deal, and we didn't touch on this, and I'm not sure that this is part of the discussion, but we also have the how that sale happens. Are they buying the assets of the business, or are they buying the entity itself? So those also have an effect on the taxes, and both on the buyer and the seller. So those are issues. I know from the buyer standpoint, they typically want to buy the assets of the business and not buy the business itself, because a lot of times there's hidden liabilities that they may assume when they buy the business, the entity, including the assets.
Yeah, that's always an important deal. It's a huge deal if you're a C corporation.
Right.
Which used to be popular. I still run into a lot of folks with businesses that they've owned for quite a while, that they were C corporations, and that provides just a tax nightmare.
Oh yeah.
And it's pretty important, and this is part of this anticipation and planning, that you can convert a C corp to an S corp, and you need to start 5 years or more ahead of the date of sale to make that most effective.
Right.
So that's another thing to take a look at. If you're a C corp, absolutely start that planning well in advance. And it might be a smart thing to do to do that C corp or S corp conversion, regardless of whether you're selling or not. It just depends on your tax situation.
Right. If I remember right, you probably have a better recollection of this, but when you do that conversion, you get a 4-year um, you roll that income that's trapped inside that C corp, the additional tax effect of that conversion, you're able to take that over the next 4 years.
Yeah, you in effect eliminate the double taxation
Right.
that can happen, but it absolutely requires advanced planning
Right.
to be able to do that.
Yeah, we don't run into that many C corps anymore, and they're just a nightmare to try to manage.
Yeah, they were popular with the really small businesses that took advantage of the 15% tax bracket up to the first 50,000, which was there forever. And that was increased to 21%. So a lot of folks don't realize that there was a tax increase on your C corps on that first $50,000. And for a really small business, that's where their profit was. That's what they left in the company. It made a lot of C corps actually more expensive to own.
Right. Rick, I've got just in review, I've got if you're when you're preparing for the sale, you want to remove the personal expenses out of the business. So anything that's clearly personal, not that you should have been taking a tax deduction for those anyway, but you don't want those running through the P&L. Maybe they were showing on the P&L, and when the tax return was done, they didn't take a deduction anyway, but you don't want those anywhere near your financials. Non-necessary business expenses, clean those up and don't have those inside the business either, such as maybe it's a car payment or an extra vehicle, or it's a family member that has a car that they're running errands or running to the mailbox, or you take an extra business trip that maybe you don't need to take. Just don't have non-necessary business expenses inside the business. Then you don't even have a discussion on how you've normalized the earnings with the potential buyer.
I once had I was appraising a business that had no cost of goods. They picked up refuse oil from restaurants, right?
Oh yeah.
And on the tax returns, there's a cost of goods of 25%. I said, I thought that you didn't pay anything. I don't. Well, what is this cost of goods? He says, it's me. I don't know. I'll check it out. He came back. He says, that's my racing car.
Oh, don't say that too loud.
Yeah, and it brings out another good point, Charles, is that there's things that you might be doing you don't want other folks to know,
Right.
that you don't want to be discoverable.
That's true.
So you want to clean this up.
Right. Yeah, because once you go into that process, you're going to basically turn your books over to somebody else to do due diligence to verify that, yeah, what they're presenting to me is the truth, and I'm going to base my purchase price on those numbers.
And another classic one is not reporting cash, having a cash sensitive business, and you would get, well, my gross is really about 25% higher,
Right.
because I take cash. And I would say, well, do you want me to put that in the footnotes?
Right. That would be something that the IRS agent may want to see that you don't want them to see.
And my position would be, you have received your benefit by taking that under the table.
Right.
And you're not going to get that in the price.
Yeah, you can't then sell that. So
Correct.
if you do, good luck with that. So yeah, that's and that's why a lot of times there's conflicting interest in how you present the numbers and whether you have a business expense or not. For instance, maybe there was, although it's illegal, that business owner you're referring to, they were somehow incentivized not to report that cash. They had cash, they could put it in their pocket rather than running it through their business. They didn't pay taxes on it, which is totally illegal. We're not approving that or endorsing that. However, when they go to sell the business, they can't then take credit for that cash that they didn't report. So that's
right. And it's a good reason to start 2 or 3 years ahead of time.
Yeah.
Because probably, well, it depends, but it'd probably be a good thing to start claiming it.
Well, bottom line, you should.
Right?
Yeah. bottom line, you should be legal. You should report all of your income, whether it's cash or whether it's paid by credit card or check or whatever. You report all of your income. You sleep at night, and then you're building your books correctly, and you've properly reported for tax purposes as well as financial statement purposes all of your income and all of your expenses.
Exactly.
So we're about doing things on the up and up. So there is the other things you mentioned was a compensation adjustment to the owner. So that may involve increasing or decreasing the owner's compensation. So anything else on the financial side that needs to be cleaned up prior to the having the books ready for sale.
Another thing I like to do is to come up with a true sinking fund for the replacement of equipment. The depreciation may not really accurately reflect what's happening, especially let's just say you write everything off the year you purchase it.
Right.
Well, that's not accurate. So, and this is another thing that a buyer will understand. When you're stabilizing that income, uh, figure out, let's just say the average piece of equipment lasts 5 years. So figure out a sinking fund so that you're saving 1/5 of that replacement every year for 5 years. So maybe your sinking fund, your real world depreciation is 1/2 of what the tax depreciation is.
Right.
That is perfectly okay. That's very explainable to a buyer. So you want to make sure, and it works the other way too. Sometimes the depreciation is so low that that it needs to be vastly increased because things are wearing out. So that's another thing to be really honest with and adjust that real world.
Good point. Are there any other items that should be considered from an operation standpoint? We talked a lot about the financials, how to classify and how to remove things out of that. On the operation side, I would just state the obvious that you want to remove any inefficiencies in the operation of the business and maximize on those that result in the highest profitability.
Yeah, sometimes we can get kind of lackadaisical with some of the expenses that are going on. Recently, I saw an audit that a person was paying 20,000 for that could be done for 6. It's a great time to really take a look at all of your expenses. And and here's the other benefit with that. Selling a business doesn't happen overnight.
Right.
Not like a residential home that you can pretty much count on 90 days, and in this environment it's going to be sold. My rule of thumb is it often takes a couple of years to sell a business. So in doing all of this, you can actually recoup some of the benefits yourself if you've maximized cash flows and minimized expenses.
Absolutely. And that, the industry that the business is in is really going to dictate the time period that it takes to sell, as well as the multiples on that sales price or on multiples on EBITDA. So the calculation to determine valuation, if the business owner understands that, if it's an EBITDA calculation, if it's an asset-based calculation, if it's a combination, then if they understand that early on, then they can adjust the ways they operate and do their financial reporting to best maximize the sales price when they do initiate a transaction.
Yeah, we haven't gotten into that much of then how do you price the business once you have the EBITDA? And there are so many different ways to price a business, far more rules of thumb, so to speak, than with a piece of real estate. A piece of real estate it's pretty easy.
That's pretty easy, right?
If you have a McDonald's or a Burger King, those are really easy because they're all so cookie cutter.
Right.
But most small businesses are not cookie cutter. And in some ways, the smaller the business, the harder it is to price because there can be a lot of emotional factors in how a buyer values it. And there are many, many times I would use 3, 4, or 5 different ways of valuing a business to come up with here's where I think we're going to be.
Right. And you know what it always comes down to in any buy sell transaction, no matter if you're buying a piece of candy or if you're buying a new house, a piece of real estate, or a business, it always comes down to a willing buyer and a willing seller that agree upon a transaction price. And that's no better case of that in buying and selling a business, and one that is not publicly traded. If it's publicly traded, then the formula is set for you.
Sure. And it can help you a lot of credibility. You as seller, you can gain a lot of credibility by showing the buyer how you came up with the valuation.
Right.
And if you can show them, well, here's the cap rate, or here's the return on investment. And maybe I took all the hard assets that I have, and I figured I wanted 20% or a 10% return from the hard assets. But on the blue sky, maybe a 30% return is reasonable. The more you can do this for a buyer to justify the price, the easier it is. The PFA method of valuing a business often doesn't fly, and that is the plucked from air value.
Right. I like that. The air, that's much cleaner.
So, and if you can tell, well, when I do it by EBITDA, it's this value. When I do it this way, it's this value. You can start providing some credibility to that buyer.
Yeah, I think
Okay,
that is so true. And I've assisted buyers and sellers in a transaction before. And not only is that, if the buyer comes up with a valuation, not only is it important for the buyer to be able to show his logic in the calculations, but oftentimes the seller will come up with, well, no, I think it's worth this. Then okay, well, the seller's the one that has they're offering it for a sales price, but the buyer usually wants something lower. And then it's like, okay, I've given you the seller's calculation, which includes EBITDA, which includes the valuation on the hard assets. If your number is that much different, same thing you're saying there. Show me your calculation, so then we can determine and either agree to not agree or agree to agree on those differences and meet in the middle.
yeah, absolutely. It's got to make sense. One of the rules of thumb I used is if I didn't put anything down on this business, can it be out of cash flow? Can it pay itself off in 7 to 10 years?
Right.
Just another smell test.
Exactly.
To see, does this make sense? Because it's got to be successful, and it needs to be successful for the buyer, especially if you as a seller are going to carry anything back.
Oh yeah, if there's a seller carry note on that, you want to make sure they can afford to pay that, or you may get right back in the business after they've destroyed it.
Something else to consider, especially with the new tax code, is there might be a cap. There might be a cap that says, well, if you make over 400,000 a year, we're going to do away with your capital gains.
Right.
So there could be additional planning here that will encourage installment sales.
Right. Exactly right. So there's a lot to that, and the bottom line is to plan. And I think the providing the transparency on how you do the calculations, I think is critically important. Give us the we talked about EBITDA. So there's the methods are going to involve of the calculation for valuation are going to involve EBITDA, which is earnings before interest, depreciation, taxes, and amortization. Mm-hmm. Then you're going to have the valuation of the hard assets that are there, and those are going to vary depending on what industry and what business it is. So, but those are more typically those are probably more objective, because a lot of times for the equipment there's going to be stated prices on what that equipment is, or it's 50% of what the original purchase price was, or there's more that can be more objective than the blue sky or the multiple on EBITDA.
Yeah, and that can be a challenge. I will often ask the owner, give me the rummage sale value, give me the auction value
right.
of your equipment. Where that is really problematic is in the case of a restaurant.
Absolutely. Yep.
Because what you buy new there's nothing that often is worth less than used restaurant equipment.
Right. Absolutely right. And there's a lot of restaurants that are either selling or going out of business. So you got a lot of that to deal with.
Yeah.
Unfortunately. Yep. Rick, I think we have anything that we're leaving out. It seems like we've covered a lot of ground in the discussion where we've gone through how to prepare for the sale, what to look for in the taxes, how to time the sale based on the tax rates that are in effect at that time, how to make sure that you strategize around that, the timing of the transaction, and how to clean up your financial statements, and just how the calculation is done.
Yeah. The one thing that we don't have time to get into, but also needs to be paid a lot of attention, is the emotional impact of selling. And a person needs to start preparing for that, because a lot of us define ourselves, identify ourselves with what we do and what our business is.
That is true.
And so how is life going to look like when I sell my business?
True. Very good point. And you've got a whole section where you deal with the emotional part of businesses. So, nice advisory service there. So, before we leave, pitch your business, Rick. Give us a little bit of information about your business.
Yeah, well, I recently wrote an article. I said, when I don't feel like talking to somebody, I tell them I'm a financial advisor, and the conversation ends.
I saw that
If
column.
I feel in a talkative mood, I say I'm a financial therapist. And that's, what is that? So we do combine typical consulting, business consulting, financial advising, investment advising, along with financial therapy. And that can be as simple as, what do I want to be when I grow up? What do I want to be if I sell my business? Should I even be selling my business? And why? And how do I deal with the family? How do I deal with, for example, setting up the intensely defective transfer trust? That is a huge emotional event, because you're not in control of everything anymore.
Right.
So we deal with all of this, and our typical clients are business owners, professionals, and retirees.
Very interesting. I like that. You're not a financial advisor. You're a financial therapist.
I am a certified financial therapist, level 1.
I like that. Very good. That's a much more appealing opening line, and you really appeal to people's emotions when you do that as well. So thank you so much, Rick Kahler from South Dakota,
Yes.
Rapid City, South Dakota. Thank you so much for joining us. This has been a great show. Thank you so much for bringing the nuggets of knowledge about how to prepare your business for sale, what to look for, and how to prepare emotionally for that after the sale. So very good tips, very good information. Thank you so much.
Yeah, thank you, Charles.
We'll
It
have
was
to
a
have you
great
back.
interview.
We'll have to have you back for another show, because you've got just a wealth of knowledge that you can help our audience.
I've not often been accused for a lack of words.
All right. Well, good deal. Thank you so much. And you have been watching Answers That Count. I'm your host, Charles Musgrove. Tune in next week for another exciting show of Answers That Count. Have a great day, a blessed week. Peace.